Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, we've been watching on a month-by-month basis the economy through the Federal Reserve of Philadelphia's three-month Coincident Index. As we look across the country, we can see the pinks, we can see the grays, which indicate actually a decrease in growth. Even Alaska being in the red zone with negative growth. When we look at it on an overall basis, we've been tracking this. Last month, it was a 0.2% growth. Interestingly enough, this month, most recent month, 0.2%. Over the last 3 months, 0.7% growth. We keep making the point that these charts have been very predictive in the past. When you look at the economy going into the Great Recession, this gave us a number of months preview in terms of that. And looking forward, we can then sit there and say that economic growth should be relatively slow in here at the kind of moderate pace we saw in the first quarter. But Jan Weaver from People's Bank in York, Pennsylvania, asked me to talk about the yield curve, which we've been doing in our asset liability meetings this particular quarter. That where before with interest rates just remaining low, now in these ALCO meetings talking about the rise in interest rates. So we look at the yield curve and then what happens with the steepness. Of course, we've had an upward move in terms of the yield curve getting very steep. Point that Jan Weaver made is that this should actually help community banking. It might also be the reason that as we moved into the second quarter that margins started to actually moderate instead of declining. That this rise in rates could be a good thing in terms of mortgage rates. When we look at it from the standpoint of near zero at this particular end, most likely another 2 years of those low rates, which as Jan pointed out, it keeps our cost of funds very low in here. That then we can take advantage of this overall yield curve moving up. But at the same time, what we've been talking about in ALCO meetings is that even though we've had a move up in terms of those longer term rates, that commercial real estate loans have not budged in here. The competition has really just kept the lid on those loans. Mortgage rates up, yes, but along with it is that there might also be an opportunity when we're looking at this to lock in some longer money. Some banks out there indicating that longer term CDs in that 5-year bucket, they're starting to see some people move into those with the thought that maybe at some point in time that they can basically cash in those lower rate CDs into higher rate CDs and get a higher level of interest during this time period. So this is one of the things we want to think about. Should we be locking in some money at this particular point in the curve? But the one thing that we know is that this end of the curve will most likely remain low for the foreseeable future. And then the question mark is the up and downs of this part of the curve. Can we take advantage of that? This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.